Hi, everyone, and thank you for joining us for the final session of Cherry Bekaert's 2022 Professional Services Virtual Conference Series. My name's Scott Duda. I'm a partner and the leader of Cherry Bekaert's Professional Services Industry Group. Our virtual conference series is designed to provide quality, industry-specific CPE at convenient times, all free of charge. We hope you were able to join us during this speaker series. If you'd like to view any of the previous sessions, the recordings are available on our website. The link is also in the chat box. Here are a couple of notes before we get started today. To receive CPE credit, and I know that if you're like me, it's the middle of December, we're all looking for CPE. You must answer at least 3 of the polling questions. There'll be 4 questions, you must answer at least 3, and you must attend for the full 50-minute session. CPE certificates will be issued via email within 10 days. If you haven't received yours after 10 days, please email the email address here on the screen, cbhlearning@cbh.com. A recorded version of this webinar will be available in about a week and will be sent via email and posted to our website. If you have any questions during the webinar, please type them in the Q&A window that's located in your control panel. Just another short note. A short survey will be posted at the conclusion of the webinar, and we'd appreciate and value your feedback, and we ask that you take part. Now, I'd like to introduce today's speakers. I'm joined by Ron Wainwright, partner in Cherry Bekaert's Tax and Credits and Incentives Advisory, along with state and local tax leader and partner Kathy Stanton. We also have Cherry Bekaert's Tax Services Senior Manager, Zachary Hancock, here today. Ron, please take it away.
Thank you, Scott. So our first polling question for today is how did you hear about the webinar? Current client of Cherry Bekaert, email from Cherry Bekaert, friend or colleague, social media, other.
And I'll just jump in here and remind everyone, for CPE, we will leave all of these polling questions open for 1 minute. We won't announce when they will close, but we'll leave them open for 1 minute. And so please be sure that you participate.
So Maddie, let's go ahead and post our polling answers. An email from Cherry Bekaert. So excellent. So we appreciate, as Scott has highlighted, you joining us today. So over the next 55 minutes, we will cover a number of year-end planning opportunities, as well as identified year-end tax planning techniques. And we'll also talk about 2 major pieces of tax legislation that impact the professional services group. The Inflation Reduction Act of 2022, as highlighted on the screen, was somewhat a surprise agreement between Senators Manchin and Schumer in late July, which ultimately paved the way for this tax legislation. So it was signed into law on August 16th of 2022. Most of the provisions, and we will discuss a number today for not only year-end planning purposes, but also looking forward in time, will take effect January 1 of 23. There were a significant portion of this $500 billion act that were really remnants of the Build Back Better plan that ultimately failed in the Senate. And there's a number of key revenue raisers that we want to make sure you're paying attention to that my co-presenter, Zach, will speak about. When you think about the Inflation Reduction Act, think about it in the context that it is a multitude of clean energy tax credits and deductions. And our discussion today, we're going to have to limit our highlights specifically with respect to what is attributable to the professional service group industry. So next slide, please. So before we get to the Inflation Reduction Act of 22, there was another piece of tax legislation that will ultimately impact professional service entities, which was referred to and is referred to as the CHIPS for America Act. The one takeaway that you should be focused on in serving, quote, the industrial or manufacturing industry, which a number of engineering firms and architectural firms and others serve, is this new Section 48D credit, which is in fact the advanced manufacturing investment credit. As I mentioned, this was signed on August 9th of 2022. This is actually a $50 billion piece of tax legislation. But what most taxpayers do not realize is that Congress appropriated another $200 billion to impact this manufacturing, as well as all the suppliers underneath manufacturing facilities around the Semiconductor Act. The new credit is 25% of the qualified investment in advanced manufacturing facility, as well as there are credits for the suppliers. So from an engineering and an A&E firm, this is very important to pay attention to. The primary purpose, as we know, of the CHIPS Act was really on a national and a global level to compete with respect to the manufacturing of semiconductors, as well as the underlying equipment, and really to bring it back to the United States. The credit note applies to property placed in service after 2022. So from a design perspective, as well as an announcement perspective, close to $100 billion of new facilities have already been announced in regards to advanced manufacturing facilities for the manufacture of chips. And most importantly, there's a provision whereby the taxpayer can elect to treat that credit of 25% as in essence a tax payment or a refundable credit. Now, moving on to the Inflation Reduction Act, getting back to really where our focus was. And we'll just cover a number of these at a high level, and then we'll do a deeper dive specifically into 45L, as well as 179 Cap D and some of the others. So when you think about the 45L credit, quote, the energy efficiency home construction credit, as well as how architects as well as engineers are assisting their clients in this, when you think about a mixed-use property or multi-use property or a multi-residential property. This credit actually had expired in the statute and was reinstated for 2022, going all the way through 2032. As we'll talk later, this credit traditionally under old law was $2,000 and under new law is $5,000 if you meet certain energy efficiency standards. Now, 179 Cap D, this is very, very important for those of you who are deemed to be designers of energy efficiency systems, specifically in the engineering or contractor or A&E world. So 179 Cap D now has a modified formula to ultimately determine the eligibility of the new construction. As well as there's a new deduction that resets every 3 or 4 years, and we'll talk more about that in regards to what's referred to as the retrofit of a property to an existing building. There's a Section 48 investment energy credit that you will likely, as either an A&E firm or whether it's an engineering firm or others that are serving industrial and or recon industries, are going to need to be aware of. And this deals with beginning of construction extended to end of 2024, where the base credit rate was lowered to 6%, but then it was expanded specifically. Next slide, please. The other credit that was put in was Section 30D, which is an alternative fuel vehicle refueling property. Now, this becomes important when you think about the professional services industry and all of the alternative fuel and refueling properties that will be acquired and or asked to be constructed and or engineered. So specifically, it's a 30% of basis of property, and it raises the overall credit limit to $100,000 and again, extended to 2032. There's a new 40A or biodiesel or renewable diesel, which is also extended through 2024. Next slide. And then there's 45W, which is a qualified commercial clean vehicle. So this is the big push in regards to electric vehicles. Some of your companies may be very interested in investing in those when you think about your own fleets. All electric vehicles, hybrid plug-in vehicles, fuel cell vehicles. Now this credit equals 15 or 30% of the basis with a maximum credit allowed at $7,500 for vehicles that are of a gross weight under 14,000 pounds. And then there's a $40,000 amount for credit for heavier vehicles when you think about your fleets, if you're in a logistics business. And again, this is also a requirement that it be acquired from a qualified manufacturer when you think of your fleet vehicles, as well as it is effective for vehicles that are acquired, again, after 2022, that January 1, 23, and again, the place and service date. And again, it applies through 2032. So 45X is another new credit, which is the Advanced Manufacturing Production Credit for components and critical minerals sold after 22. So you might be advising clients in the professional services industry in regards to all of these type of credits, but the Advanced Manufacturing Production Credit, very different than the Advanced Manufacturing Investment Tax Credit. That credit is based on the basis of the underlying asset. This is actually based upon the production of the components and the critical minerals which have been sold, which will be ultimately utilized in the solar energy component or wind energy component or inverters and battery components that you all are likely either constructing or advising on from an engineering as well as an architecture perspective. And then you have a new credit which deals with what is referred to as energy storage technology. Significant aspect of this credit is in regards to battery storage. And then there's a number of other new credits that you likely will be advising on. We want to make you aware of around the credit for production of clean hydrogen, electricity, and fuel. Next slide, please. Now, interestingly enough, in the Inflation Reduction Act, there was a concept called boosters. So what does that exactly mean? It means that you can boost a credit up to 5 times the base amount if you pay wages at a prevailing rate, and if you provide or have a workforce that is utilized from an apprenticeship program perspective. And the IRS just recently announced on November 30th, the initial guidance around prevailing wages, as well as the apprenticeship program. It's also important because you can get a boost of these credits in regards to the domestic content. So as you are advising from an engineering or from an architectural perspective or from a contractor perspective, you're going to also get and receive questions around domestic content. The activities that occur in specific target areas around the low-income communities and housing projects, as well as what are referred to as energy communities. This is Senator Manchin, where you have a specific around near a coal field or an oil refinery. And then you have tribal lands or American Native lands, all have special provisions. Next slide. Within the Inflation Reduction Act around monetization, you have refundable and what are referred to as transferable credits. Again, these provisions were very targeted towards tax exempt organizations that now can receive a refundable credit or what's called a direct pay, as well as a governmental unit and tribal governments being American Native, as well as other similar organizations. The key here is a lot of tax exempt organizations are going to seek your guidance in regards to the type of work that you are providing in regards to your service offerings. And then again, you can elect to refund the credits, even if you're not subject to federal income tax and you have no liability, you simply elect and the government will write you a check. As well as you can sell the credit in the event that you want to utilize it and monetize it for you, but then anything else can be sold to what is referred to as a vendor. That's really opening up what's called the third party or the transferability causes. And this will ultimately change what we often refer to is the tax equity markets around equity financing. So pay attention as well as the Inflation Reduction Act dealt with R&D. Hopefully a number of you all are taking advantage of the research and development credit placed in the statute in 1981 and is permanent in this statute. Credit ranges from 14 to 20%. So in regards to the R&D credit, think about it as you can elect to apply the R&D credit against payroll tax liability if you are deemed to be a qualified small business, depending on how long you have been in operation. But most importantly, I want the takeaway for you to be that the credit was increased from $250,000 to $500,000, beginning for tax years, again, that January 1, 23 magical date. But also now, instead of just formally offsetting against FICA, it was expanded to include the employer Medicare tax. And so the credit can also offset all that payroll tax for a period of 5 years if you meet the definitions. Again, it really was focused on startups, if you will. Next slide. So let's go through some things that I always want to include when we think about professional service entities, because ultimately as a pass-through entity, it's all going to settle into the individual. So here are some of the key things you need to be aware of. 25C, which was the energy efficient improvement to residents, there's credits there. Residential clean energy property under section 25D. This is a new credit that also applies to battery storage technology in regards to residences. Next slide, we already talked about 30D, the clean vehicle credit. So around electric vehicle charges, there's credits, as well as then the clean vehicle credit in the event that you're acquiring or replacing your fleet. And you may have seen that a large pizza chain just announced that they were going to be going all electric. So the next time you get that pizza, you know who I'm referring to. It'll be in an electric vehicle pursuant to the commercial on television. Again, this is a credit for you. So when you think about raising revenue, I'm going to turn it over to my co-presenter, Zach, and he's going to take us through a number of slides on the raising revenue side of the Inflation Reduction Act. Zach?
Great, thank you, Ron. So as Ron was detailing, the Inflation Reduction Act passed several key provisions on healthcare and climate change. So to get the bill through the budget reconciliation process, Congress had to raise revenue. And Democrats focused on taxing the rich, as they say, being individuals and corporations, with the goal of not raising taxes on the middle class. So they tried to accomplish this in several ways. The first was the excess business loss limitation. So this is the limitation on business losses greater than about $500,000 for married filing joint per year. It was originally put into law by former President Trump in 2017 with the Tax Cuts and Jobs Act. That ran from 2018 to 2025. It was reprieved by the CARES Act for a couple of years as part of the COVID relief response and extended to 26. And now under the Inflation Reduction Act, it's been extended to 2028. And again, this is a limitation on net business losses over $540,000 in 2022. Now, I'm sorry, if you can go back a slide, we'll run through a couple of these. So the next piece is the corporate AMT. So Congress passed a 15% minimum tax on what they perceived to be the abuse of corporations who had high earnings per share, but did not pay a lot of tax. And so what this is a tax on adjusted net income for book purposes. In order to qualify, there's a high bar. There has to be over $1 billion of receipts on a 3-year average. So they're targeting large public corporations. The adjustments include things like NOL adjustments and tax depreciation. So these companies will still get the benefit of investing in property and equipment. But again, it's to fight the perceived abuse of high earnings per share, but low tax paid. A couple other revenue raisers that the Inflation Reduction Act has is a 1% excise tax on corporate buybacks. Again, that's just a non-deductible tax paid by corporations on 1% of the value of their buybacks, publicly traded corporations only. And then IRS increased funding by about $79 billion, and they expect to generate over $100 billion in addition to what they're spending on targeted audits. So another point to mention is bonus depreciation. So the Tax Cuts and Jobs Act had 100% immediate write-off of property and equipment placed into service, and that ran at 100% until the end of 2022. Now, starting in 23, it drops to 80%, and will continue to phase out at 20% a year until 2027. And what this is you can deduct 80% now going forward of the cost of new assets or used assets, which are new to you, which are placed into service. So the important thing to remember is it's not enough just to purchase property and equipment. In order to get this benefit, the property must also be placed into service by the end of the year. And lastly, it's also important to note that states generally do not follow this rule of accelerated depreciation. And so in the first year, if you have a large property and equipment bonus depreciation, you can expect a state add back to your income, which will reverse in the coming years, but just something to think about as you might have state tax payments, even if you have no federal tax payments related to bonus depreciation. So going back to the excess business losses in a little more detail. So again, this is a disallowed loss on the aggregate of your business losses. And so this is from flow throughs from partnerships and S corps or sole proprietor, any trade or business income reported on an individual return. And so in this example, if you have 500,000 of gross income from one partnership, but a $1.2 million loss from another, that net loss is what's considered for the limitation. And so in this example, the 210 loss is disallowed in the current year, but then is carried forward indefinitely. So I'm sorry, we can jump back one slide. What's important to think about, just as an aside for this, is if you're undergoing any cost segregation studies, where you accelerate depreciation for lower life assets, that could push you into a situation where you have a lot of losses for 1 year, but these limitations might prevent you from seeing that benefit in a given year. And again, this is after the passive loss rules or basis limitations. This is a fourth level of limitations, if you will, passed by Congress. So there's something to think about. So for NOLs, this is also something that has changed recently. So it used to be that you could carry net losses back 2 years. That was eliminated on the TCJA in 2017. Now losses can only be carried forward. And what's important to keep in mind when you're thinking about tax planning is only 80% of your taxable income can be offset with prior year losses. So if you have a year with large losses, and then in the current year, you're expected to be an income, you cannot expect that entire year's worth of income to be wiped out by your prior year losses. If you are expecting prior year losses, you'll only be able to receive about 80% of that benefit. And so you'll still be paying tax on about 20% of your taxable income. And that's what this example is showing. And again, even though you can't reap that full benefit in the current year, the disallowed losses are still carried forward definitely. So what was not addressed in the Inflation Reduction Act? The corporate tax rate did not change. There was talks amongst Democrats of increasing the corporate tax rate to 25 or even 28%. That remains unchanged at 21. The SALT cap limit of $10,000 for the individuals was not changed. A lot of Democrats, especially in high tax states like New York and California, wanted to remove the limit of $10,000. That was not able to get reconciled with the revenue raiser, so that had to be dropped, and provides a lot of opportunity for the pass-through entity tax, which Kathy will be talking about in a moment. Sorry if we could jump back. Carried interest was discussed of having that changed, but there's still a 3-year holding period, and you can receive long-term cap gains on carried interest. There was talk about it being treated as ordinary income, but that was not added to the final bill. There was no extension of R&D expensing, so now we're hoping that that gets extended in the tax extender package that Congress hopefully will take action on. And there was also lots of discussion along changing the scope of net investment income tax, which is a 3.8% surtax on certain types of income. Congress had talked about increasing that to apply for non-passive income. So lawyers, doctors, accountants, all those types of businesses who are structured as pass-throughs could have had an additional 3.8% increase to their tax. That was not in the final bill. So we can go to the next slide. So just a couple other quick planning considerations. This is the time of year when you're doing tax plannings to consider accounting method changes, whether that be an acceleration of prepaid expenses, or also making sure that your accruals at the end of the year can be deducted. So for S corps, no bonus accrual is allowed for shareholders. It must be paid by the end of the year to be deducted. And then in general, most corporations must have their bonus accruals paid by March 15 if you're a calendar year taxpayer in order to get that deduction. So it can be a fixed and determinable bonus from a tax perspective for the end of the year. We can go to the next slide, brings us to our second polling question. Are you familiar with 179D tax deduction? Very familiar, somewhat familiar, or not familiar at all? Again, this is for CPE and we'll leave this open for about a minute. So please make sure to answer the question and click submit so you get credit. Now everyone needs CPE this time of year. And so while we're waiting for that to close, there it is, somewhat familiar, 47%. And with that, Ron, I will turn it back over to you.
Thank you, Zach. So I mentioned to you all that we would take a little bit of a deeper dive into two areas of the Inflation Reduction Act, specifically in 179 Cap D. So from the prior slide, you know that the Inflation Reduction Act, for the most part, takes effect January 1 of 2023. As highlighted, there are some provisions that are applicable and really reinstated to January 1 of 2022. But this is an area when you think about the professional services entities as well as industry, this is really a game changer. And what I mean by that is it really updates to the energy efficiency deduction. So it increases the maximum available deduction from what was old law of really 60 cents per building component, which ultimately got us to $1.88 in 2022. It is $1.88 from the standpoint of indexed inflation, but now effective January 1, it really almost triples in values to $5 a square foot. So if you think about a simple example of a 100,000 square foot building, and you potentially are the designer of the energy efficiency system, or you may own that building, you're thinking about, well, previously I could have been eligible for $188,000, which is in essence $1.88 times the 100,000 gross square foot. But now change that to 500,000 square foot. So some significant opportunities there as you either look to assets that you hold, are building or constructing or expanding or renovating, or those that you are consulting on. And we'll talk about the expansion of the buildings next. So expansion now includes the tax exempt entities. They may allocate their 179 Cap D deduction to designers. Remember, the old rule was any governmental entity, which excluded not-for-profits. Well, now they are included. And so that all includes churches and charities and hospitals and private schools. Next slide. So the other key item, which I mentioned, is that now the 179 Cap D deduction is no longer a one and done in regard to the underlying asset. So what does that mean? That means that you can ultimately recalculate the 179 Cap D deduction for the same asset, for the same building. And it's really now taken every 3 years if it's a commercial piece of property, or 4 years if it is more of a tax exempt entity owned property. And so it does apply, very important, to all relevant upgrades to the building made during what is called an aggregation period, which is a 3 or 4 year period. So we're no longer in that one or done. I already mentioned the new prevailing wage and apprenticeship program in the earlier slides. Again, the IRS gave us initial guidance. And this is how, when you think about $5 a square foot, or if we were dealing with 45L, 5,000 per unit, these are going to be the requirements that must be met to, in essence, receive what I highlighted was those booster credits and or deductions. And so the note that the IRS guidance is still to come is intentional because we saw the first release on November 30th. We talked a little bit about 45L. Again, these changes take effect January 1 of 23. Simply be aware that it increases the maximum available credit from the old law of 2,000 up to 5,000 per unit. So a simple example again, I have 100 units. Previously, that was worth $200,000, and now it's worth $500,000. So just a significant change when you think about what's happening, whether that's in multi-residential, multi-use condos, single residentials, et cetera. As well as some of you may know that there was a provision previously in old law where you only were eligible for the 45L if it was in essence 3 stories or below. That height limitation has now been removed. So I now can be looking at a high rise of 15 or 20 stories. Now, this is on the 45L side where things did in fact change in regards to a new energy standard, specifically with respect to the 45L, which is called Zero Energy Ready home certifications. And then there's also partial credits available as well. And so what does all this mean? The Department of Energy released the first guidance on what is referred to as STAR, or the Zero Energy Ready home certifications, or quote multi-residential certifications, on November 1st. It's rather a comprehensive document, but we stand ready to help kind of guide you forward in regards to if you want to take advantage of that. A couple of chats real quickly. Are there tax credits for homeowners that installed a new HVAC system in 2022? The answer is yes, from that standpoint. So next slide. Again, remember this prevailing wage apprenticeship program. Don't want to hammer this home, but this is a very critical, because that gets you to the 5 times amount, depending on the energy type provision that we're dealing with, and whether you're consulting on whether it's in the industrial industry or the recon industry. So to qualify, you're going to meet those new provisions. We don't have time to go in, but we do have a thought leadership piece out there. Now, the tax trifecta. This is where if you own or you're potentially consulting, this is an area that you need to be very familiar with. So any building over 3 stories, as I already mentioned, was limited to 45L. It can now qualify for what we call the tax trifecta. So now you can have a cost segregation study done, which Zach mentioned, and you can have a 179D and 45L, all attributable to the same underlying asset. So the government literally could be subsidizing you a significant amount to the extent you're a engineering firm that may be looking to build a building or expand the existing building. These are all things to take into consideration, especially if you're consulting in condominiums and rental complexes over 3 stories in height. The other thing that you may be considering is a professional service entity, and you might be advising clients on this as well, is really there was the expansion of the solar credit. Again, we don't have time to go through all of the credits in detail. We just tried to highlight those that we think are most applicable to you all. But remember that the solar credit was reinstated to 30%. It was 26%. And then also that extension goes through 2024 at the 30% of what's referred to as the investment tax credit. And remember that solar and qualified fuel cell, waste energy recovery, geothermal, it is very, very comprehensive. And I would tell you that there are certain solar projects which are placed in service, because remember this is kind of a reinstatement that ultimately may and only qualify for the 26% from that standpoint. Which I believe, Zach, brings us to a next polling question.
Yes, thank you, Ron. So polling question number 3, has your company scoped to see if you are eligible for the employee retention credit? Yes, we have already applied for the credit. Yes, we are not eligible for the credit, or no, we have not. Again, please make sure to hit submit so you can get credit for CPE. The CPE certificates will be emailed to you after the closing of the polls. Excellent. So the majority know we have not. Great. So that brings us right into our next topic of the employee retention credit. So the employee retention credit was put into place because Congress had the goal to keep people employed and out of the unemployment benefit system. So as opposed to paying out more unemployment benefits, they offer these credits to employers in hopes that they will keep employees retained and out of the unemployment system. So this is a credit against the employer portion of the FICA tax and is claimed on the quarterly payroll deposits by the company, so Form 941. The rules have changed as the COVID response progresses. And so you'll see on the slide here, we have some initial rules in 2020 and then the new rules and how they changed in 21. So we could jump to the next slide. So who qualifies? So businesses that had a government mandated shutdown, either partially or fully, or they had a significant decline in gross receipts. And a significant decline is typically about 80% from the same quarter relative to 2019. Gross receipts is a more common qualifier in 2021, and the government mandated shutdown was more prevalent in 2020, not so much anymore as the COVID response progresses. So there are stricter rules around a partial mandated shutdown. You have to have more than a nominal portion of your business mandated to be shut down, and that's typically measured by a 10% or greater reduction in your receipts or your employee hours compared to 2019. So again, 2 ways to qualify. We could jump to the next slide. So note that the CDC and the OSHA are not government orders, and these will typically get denied on an audit. And if we could just jump to one more slide. Perfect, thank you. So this has been a high area of focus for the IRS, and you've likely seen in the news that some of these ERC audits were made public for large companies or even small companies that had, fraud with the ERC. So again, it's important to make sure that you do qualify before you actually apply for any benefits. And again, a government mandated order does not include the CDC or the OSHA. So just to be clear. And so in order to get some of these credits, or if you do get them, I should say, you might have to amend prior year returns to reduce deductions claimed in those prior years. So just something to keep in mind if you do receive these benefits. So switching gears slightly to the R&D tax credit. So as Ron mentioned, this was made permanent in the code in 2015, and this is a product or process improvement could qualify. And again, this is something as improving your methods or improving your product. And so the credit is typically 4 to 19% of your qualified expenses. Typically that is payroll. If we could jump to the next slide. Yeah, so you can go back and claim the credit on your return where the statute is open. It's typically the prior 3 years. After 3 years, your tax returns close and you can no longer amend those years. And so if you're eligible for the credit, it can be claimed in a prior year. So it's important to have this scoped and looked at. And lastly, the big thing to mention, and that was discussed briefly before, is that the Section 174 is sunsetting this year, and that allowed companies to expense or write off their R&D expenses in addition to the credit. That was expected to be included in the Inflation Reduction Act and ended up not being included. And so now action is needed by Congress in order to extend that benefit of being able to expense the R&D qualifying expenses in a current year. If action is not taken by Congress, those expenses will need to be capitalized and amortized over 5 years. So now I will kick it over to Kathy to talk about the pass-through entity tax.
Great, thanks, Zach. Yeah, so let's take a few minutes on state pass-through entity tax elections. This is really, really important, a really good opportunity this year. I will say that in practicing 37 years, this is one of the biggest changes in the state tax world, and it's for your benefit. So you really want to take a look at this because you don't want to miss any deadlines and lose the benefit. So basically, with regard to the background, we mentioned previously that there's a $10,000 cap on the ability to deduct state income taxes from your individual tax return as a pass-through entity member. However, if an election is made under these pass-through entity tax elections that have just been enacted in the past couple of years, you can actually calculate the tax and impose the tax at the pass-through entity level. So what does that do? It puts a pass-through entity on par with a C corporation, where the pass-through entity can actually deduct that state income tax from its federal taxable income. So when you receive your K-1, that ordinary income is reduced by the state income tax. So that's how you get the benefit, is a reduction of ordinary income due to the state income tax that is deductible at the federal level. If an election is not made and it's a state that treats the pass-through entity same as federal, you would be capped at $10,000 of a state income tax deduction. The IRS has given a head nod to this under their notice that they issued at the end of 2020. That yes, this should work and regulations will be forthcoming. However, regulations have not been issued yet. Not sure that they ever will be, but there's at least a head nod. And since this notice came out, there's been a flurry of activity with regard to how many states have enacted these elections. So you can go to the next slide. We only had 7 states that had enacted legislation prior to the notice, and now we are up to 30 jurisdictions, 29 states, and New York City. There's legislation pending in 3 states. I have as of November, but that's as of today as well. Nothing's moved past this. So you can go to the next slide. How does it work? So generally, I mentioned with regard to the K-1 income that you get a deduction, your K-1 income. But then when you file your state resident return or non-resident return, that income has to be removed so that income is not double taxed, or a credit has to flow through. So this is more details that we don't have to get into too much here, but basically either that income is going to be removed from your state income tax return at the individual level, or a credit is going to flow through so that there's no double tax. So again, really pass-through entity elections just electing to impose tax at the entity level instead of the individual level, thereby converting that state income tax to a deduction. You can go to the next slide. So here we are. Here are all the states and the effective dates or effective years that these elections are in place. We can't be simple about anything in the state tax world. So every state has its own unique statutes, its own unique eligibility requirements, its own unique nuances, what income gets included. Of course, the states have to be complicated, which should be no surprise for those of you that are experienced in the state income tax world. In a particular note, Colorado made this retroactive to 2018, back to 2018. I'm not going to be able to do that yet because they don't have the systems in place, but that would require amended returns. Within our footprint states, notice the state of Virginia enacted as of 2021. However, for 2021 tax year, you're not going to be able to claim it until 2023 because they don't have their systems in place yet either. However, we should be able to claim it here in 2022 for tax returns filed in the 2022 year. You can go to the next slide. Okay, so here are the considerations. Qualification. Does the pass-through entity qualify? Some states indicate it has to be all individual owners. You can't have a partnership owner, a C Corp owner, any other type of owner, or you can't make the election. So there are qualification requirements with regard to types of owners. There you want to look at maybe some restructuring opportunity. Can you set up a partnership that's only owned by the individuals that are owning the pass-through entity to get the benefit, and so forth. Tax base. Some states, it's a portioned income that's included in the tax base at the pass-through entity level, which makes sense. That's the way you're currently taxed for state income tax purposes. And I will note that the states, this is revenue neutral for the states. They're just moving who's paying the liability. They're not changing the liability. However, in some states, such as California, North Carolina, and Virginia, if you are a resident of those states and the entity makes an election within that state, the entire K-1 income can be included in the pass-through entity tax base. This may provide additional benefit to you if you have sales that really belong to other states that aren't that where you're not making potentially elections. You can capture all of that in the resident state. There can be some cash flow issues to that. However, you may have to pay it at the pass-through entity level, but then also pay the other states and wait till you file a return to get the overpayment of tax back. So there's some timing of cash flow as well. Also, what's included in tax base is retirement income included. There's a federal law that says it can only be taxed in a resident state. So some states carve that out, and that would be retirement income that's flowing through on a K-1. Are guaranteed payments included? I believe the answer is generally yes, but you have to look at each specific state. Election deadlines, do not miss election deadlines. California, you have to pay half of the prior year pass-through entity tax by 6/15 to make the election for the current year. So for 2022, you cannot any longer make a California election, but for next year, you potentially can. Many of the deadlines are just at when a return is filed. In most of our footprint states, it's when the return is filed. California, you can opt in or opt out by partner. That is the only state. There may be one other, but not anywhere near our footprint states. For making the election. I mentioned retroactivity. You have to look at your organizational agreement, who is authorized to make the election. You want to be careful. Because the next bullet, ability to take the credit in owner's resident state. As we have many states that are electing in, that's very beneficial. But if you have an owner that is in a state that does not have a pass-through entity tax election, and that state will not give credit for tax paid at the entity level, then you can actually double that person's tax liability or almost double it, and they will be harmed by the election. So you have to look at what does this election mean to the whole ownership structure. And if someone's harmed, you want to make sure whoever's making that election or not making that election, that they're authorized to make the election, because you can have competing goals, conflicting benefit or a taxpayer being harmed by it. You just want to be careful making those elections. Also, partner allocations. If you're including the whole residence income within the tax base, can you take the tax attributable to that entire residence income and specifically allocate that tax deduction to that partner? Some partnership agreements may not allow for that. So you have to look at how the tax gets allocated back to the specific partners. A couple of states don't allow a full credit. So you'll actually pay a little bit more. Connecticut, it's mandatory. There is no election in Connecticut. Timing of payment. So federal uncertainty, I mentioned the regs aren't out yet. So the federal government could come out at some point and say something, but I doubt with all the states, there were other taxes in play similar to this. I doubt it would be reversed, but there is a chance. But the second to last bullet, the most important for this call right now, timing of payments. If you are going to make these elections and you want to deduct the tax for 2022 for this year, and you're a cash basis taxpayer, you have to make the payment this year. So that means you got to get the payment in before year end if you want the benefit by 2022 for the current year for cash basis taxpayers. So unfortunately, that payment has to be made at the pass-through entity level. You cannot take estimated payments that were made in the individual level and just consider them paid. It has to be paid by the pass-through entity. So you really want to look, are we going to make these elections? Now, granted, you can make the payment in 2023, no problem. You'll still get a benefit, but that deduction will be in 2023, unless for some certain exceptions on accrual basis taxpayers. So really look at where you're going to make elections. Who should make an election? Very simple. Do you have a lot of state income apportioned to a state that offers an election? If you have a lot of state apportioned income to that state that offers an election, or residents receiving a lot of income in a resident state that has an election, you want to look at this. So you definitely want to give this some time and attention. So great benefit, and the benefit's a federal benefit, 37% if you're at the highest tax bracket. So you're not just looking at a state tax rate, you're looking at a federal deduction. So very, very powerful. Do not miss these. Really take a look at these. If you're a pass-through entity and you are profitable and have a lot of profit in states that offer pass-through entity elections, we're happy to help. Let us know if we can help you in any way. And I will turn it back over.
All right.
Thank you.
Kathy, thanks so much. And as you can see, the pass-through entity election, very sensitive from a timetable perspective, as well as somewhat complex as you evaluate to ensure that you are able to deduct those state taxes at the entity level. And as Kathy indicated, we're here to assist you from that standpoint. I did want to kind of go and comment on two items that Zach mentioned, just to help a little bit more towards kind of year-end planning as well as planning in general for our attendees today. So in the polling question, 43% of you highlighted that you had really not explored the opportunity to claim the employee retention credit, which came up underneath the CARES Act, not only in 20, but 21, and then sunset at September 30th of 21. So I would encourage you to go back and really reevaluate what was happening and to see if you qualify. We see that continually in our practice around missed opportunities to claim it, and those dollars can be substantial, as we know. The government mandates, whether that be at a federal, state, or local municipality level, are often the key in you being eligible for those. But we have to document those, as well as we have a thought leadership position out there in what is referred to as really the supply chain type distributions. The other thing I'd highlight is in the R&D credit area, which Zach covered. Remember that if you're a general contractor, when you think about your business components, improving your design and construction methods, specialty subcontractors, you're researching to improve your products, and roofing and HVAC and plumbing systems may also qualify depending on specifically. So when they say business component, we're thinking of a product, a process, software, technology, a technique, a design. There's literally thousands of business components that can constitute a qualified research activity. So I'm going to work through this slide pretty quickly. We are seeing in the professional service companies really a trend in regards to succession planning. In fact, a recent study has indicated to us that 65% of professional service companies are looking to transfer equity internally, specifically to an ESOP, about 65%. 20% are really uncertain as to succession planning. 10% actually have indicated that they will liquidate. And then 5% are considering selling to an outside party. Now, this was a survey that was approximately 9 months ago. What we're also seeing the professional service companies is in regards to private equity group investments, depending upon the nature of the service offering and the company. But the key here is the planning horizon is now. You need to begin to plan now over the next 5 to 10 years, because as we know, often professional service groups, which are very large, have a lot of younger up and coming leaders, and that succession plan needs to begin now. Clearly within the 2 to 5 year window, you're really, what is the method of transfer to those new identified leaders, and how soon are you going to start moving that equity? But if this survey doesn't tell us, there is a tremendous move towards internal transfers, as well as a consideration now to the private equities. But it's important to start planning now. Next slide. The keys we would highlight to you as a successful transfer is starting with sufficient time, looking at strong future cash flows to, in essence, buy out those older senior leaders. Obviously, you have to have a motivated management team. And most specifically, and why we put this slide in there, is you must pay attention to the taxes. Very, very important, because as you go through succession planning, there will be tax considerations. So when we think about that, next slide, really the type of entity that you are matters. S Corp, limited liability company, very much matters in succession planning. Highlighted was the 65% where transfer of equity is really going to be internal, predominantly in an employee stock option type plan. Obviously, you take into consideration increased gift tax exemptions depending upon the size of the organization. There's also some grantor rules or grantor trusts that can be considered. And obviously, you've got life insurance funding, but something to really begin to consider now over the next 5 to 10 years based upon what we're seeing in our practice as well as others are seeing in the professional service group entities. So let's go through in the time we have left, about 5 minutes, final reminders around traditional planning. So remember in the CARES Act, a company could elect to defer their payroll taxes. The second installment is now due to the end of 22. So pay attention to that if you elected to defer your payroll taxes underneath the first CARES Act, passed really quickly after we got into, unfortunately, COVID. You've got to take into account as well, what do I think my profits are going to be in 2023 rather than 2022 as you go through your traditional year-end planning. Cross-check your estimated taxes, and if they've already been paid. Obviously, Kathy highlighted the whole concept of PTE. Can't credit your underlying individuals to that PTE. The entity must pay that to gain that tax advantage. And then ultimately, you've got to figure out, what's my timetable if I'm going to plan for extensions, et cetera. So that's just kind of some final reminders. But let's talk about some specific things you need to think through, give you a checklist here. Next slide. So remember 160 bad debts. You can deduct if it becomes wholly worthless within the tax year. You can deduct if it becomes partially worthless within the tax year to the extent you're charging it off for book purposes. So if you're a accrual basis taxpayer, you want to really take a hard look in regards to, well, what can I go ahead and write off in regards to my bad debts? If you have a quote capital loss, if that becomes wholly worthless in the tax year in a non-business environment, you want to take a look at that from a debt perspective. Unfortunately, some of the current events around crypto and things like that, even though crypto is not a designated security. Next slide. If you think about abandoning business property where you may have been carrying really obsolete inventory, depending upon obviously your business, you want to go ahead and irrevocably discard that so that it basically is in fact gone and you can in essence write that off. If you've got non-depreciable property, termination of usefulness, the business discontinued, take that into consideration. Ultimately, you're going to look to the owner's intention to abandon from an affirmative act perspective under tax law, so you need to take that into consideration. And then you may find yourself in a situation where maybe there's a partnership interest you're going to abandon in something you all invested in. That's usually going to generate a capital loss, but take that into consideration. And then, of course, consider partial dispositions of building components. That's 263A of the statute. Those final regulations came out in about May 2018-19. So very important also, in the event that you own an asset, is to consider a loss of tenant improvements when perhaps that loss or that tenant moved out. So here's some real key checklist. Claim section 179 expenses. So we're going to give you this as a cheat sheet to help you, because ultimately I want to get in the last couple minutes to the end. But read through this around claiming section 179 expenses above and beyond 168K. Accelerating your acquisition of fixed assets into 22, again, looking at 23, accelerating your charitable donations. You may want to adopt a 12-month rule in the accounting methods for prepaid expenses, as well as intangible assets. Really take a hard look at reviewing those capitalized costs for repair costs that can be expensed as opposed to capitalized. And then Zach already mentioned the accrued compensation and bonuses around year-end planning. That brings us to our last polling question. Would you like to learn more about how our firm can take advantage of these hot topics and year-end planning strategies for 2022 in regards to professional service entities? Yes, no, maybe in the future.
Ron, while we wait for that poll to close, we did have one other question come through. How long is it taking your clients to receive their ERC credit once they have submitted their application? I know
What's that?
my clients, I think it's been about 9 months, maybe 12.
Well, I was going to say that's an excellent question. It's 12 to 18 months
Now.
is what we're conservative. So we like to communicate that it's a 12 to 18 month process. If we've done the work, we have a team that's very aggressive, candidly, in following up with the IRS and trying to, so to speak, push the process of those amended returns, which are 941Xs.
Right.
As
Okay.
most of you on this call know, the service still is about, at least based on the recent notice, still about 5 million returns have been unprocessed, which I would think a lot of those are ERC. So let's post the results, yes, no, and maybe in the future. So let me say thank you to those who attended today. We hope it was informative, and I turn it back to our leader, Scott Duda.
Thanks, Ron. Well, thank you all for joining us today and throughout the series. This concludes our final session of the series. Thanks, Ron, Kathy, and Zachary, for your time and valuable insights and tips. If you have questions regarding today's topics, please reach out to us. You see our contact information on the screen. And again, just a reminder, we value your feedback and ask that you take part in the short survey that will appear when you leave the session. Thanks, everyone.